Let's also talk about another recent IPO, very recent one, Uber. Those shares are falling this morning again after that rocky debut on Friday. The ride-sharing company down 7.6% from its initial public offering at the end of last week. Joining us now, Yahoo Finance's Blikre with the latest. So what's the sort of chatter that we're hearing about Uber's declines?
Yeah, well, I was on the floor Friday afternoon. I talked to a number of direct market makers. Those guys are responsible for making sure that there's an orderly market. And I was telling you Friday about Pierre Giacchi. He worked for Citadel. He had a very tough job on his hands because, as we know, the market was under pressure. And the DMMs who I talked to said that he did everything right. There was really nothing that Citadel could have done. They just had to open lower because the general market was under pressure. Now, some of the brokers did question if Morgan Stanley handled things properly. They were largely responsible for setting the IPO price of $45 in the first place. And another trader told me that they probably shouldn't have done it on Friday. If we remember what happened to Lyft, that was another IPO that came out on a Friday. Usually IPOs like to give themselves at least 2, maybe 3 days during the week so they don't get hit by something surprise over the weekend. So I'm looking at the shares right now. They're down about 15.8% off of their high from Friday. And if we remember what happened with Lyft, they hit $88 and change intraday, and they lost a third of their value in the ensuing days. So unfortunate timing for this IPO in particular right now, but we'll have to see what the general market does here. I think it's more a function of that than anything else. One more thing I'd like to add. I went through their financial statements, their projections for the first quarter, which they released only this morning, and it looks like the revenue for their core platform is going to be up maybe as high as 14%. These are just unofficial figures right now. But what jumps out at me really is the excess driver incentives. Last year it was only 129 million, jumping up to about 301 to 309 million dollars this year. It's an incredibly competitive space, not only for the customers but also for the drivers. I think we're going to see margins getting squeezed here, and the path to profitability is going to take many, many years.
Yeah, so can't just blame it on the overall market then.
Yeah.
We've got some challenges for Uber itself. I think it was Rhett Wallace on Friday who talked to us about that pricing war that's going to be challenging. Thanks, Jared. Joining us now on the phone, Wedbush Securities Managing Director of Equity Research, Dan Ives. Dan, you remain a bull on Uber, at least in the longer term. Where is that coming from? How concerned are you about the sort of shorter term losses?
Look, I mean, it's been a perfect storm in terms of coming out with the U.S.-China backdrop. Lyft has fallen like a rock, and investors are nervous and in a risk-off trade, especially with a company that even with binoculars you can't see profitability. It is going to be a real divisive stock between the bulls and the bears here, and it does not change our bull thesis, although I think it just shows that this is a prove-me stock coming out of the gates.
Well, Dan, let me ask you this, because you think that there's huge room to grow for both companies. $1.2 trillion market in the United States, $5.7 trillion worldwide. That would impact Uber. But they're going to have to come back to raise more money in about 2 years. The way they're burning through cash, they raised $9 billion last week, but they'll spend that in less than 2 years and a half.
Look, I mean, that's why it's an execution story. And I view it as a total addressable market opportunity name. I mean, it's 3% penetrated, $6 trillion TAM. Look, I believe on the sum of the parts, it's a $100 billion market cap in terms of that's the core value as they execute. But I could tell you from my constant conversation with investors on Friday and today, it's going to take time for this stock to get its sea legs. And especially what happened with Lyft. Investors right now on the institutional side, they're still trying to figure out where this thing should trade. And in a risk-off market, it's sort of been the 1-2 punch. That's really been the gut punch for the stock coming out of the gates.
Hey, Dan, I'm just asking you about valuation and how you look at this company, or these companies, I should say, because Uber still has a market cap of $63 billion, GM $50 billion, Ford and Tesla $40 billion, Lyft $13 billion. You know, what's the right size for market caps in terms of valuations?
Yeah, I mean, Lyft's a little tricky just because domestic ride sharing, but I view that's a name where, you could see a range somewhere in that $55 to $65 to $68 range in terms of where it could trade once it settles out. when I look at Uber, I do view it as a sum of the parts because it's that three-head monster value between ride-sharing, Eats, as well as freight, with autonomous being the cherry on top of the sundae. And that's where it's going to take time for investors to digest whether to trade. But ultimately, I think an EV to rev basis is how Lyft is going to be valued. But there's no other barometer. And that's why right now the shorts are going to win the day.
Right.
Because in a risk-off market, you're going to continue to see valuations go south.